Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So do your own due diligence.
Do your own due diligence, indeed. Okay, hang on. I'm just, for whatever reason, my right AirPod, whatever you call them, didn't want to charge. So I was trying to get some juice. So here we go. It's nice to have folks back. It's December 15th. We're rapidly approaching the year end. I'm sure a lot of folks, myself included, are taking the next 2 weeks off into the year end. So I hope everyone has an enjoyable holiday season. For those who celebrate whatever it is you celebrate. So just FYI, if you're first time joining us, I have a screen share going in the due diligence stages channel of the Discord server where I'm sharing my screen. Obviously audio only here on Spaces. But yeah, we have a few prepared things here in the newsletter that Joe put together and sent out this morning. Joe, you want to just take us away?
Yeah, let's do it. So I sent out this newsletter this morning. I'm going to talk about a few different things. First on the agenda, it's about this Tesla recall. So Tesla's recalling nearly all 2 million of its vehicles on U.S. roads, and that is quite the headline, and I've seen that headline quite a few times. And I'll be honest, as much as we are Tesla bears here, I think it's a little bit deceptive of a headline. It's essentially the NHTSA has had a problem with autopilot systems, allowing drivers to not be engaged as much as they should be engaged when they're driving. Tesla's obviously called the system's autopilot, but that's not quite what it is. You're supposed to be fully engaged. You're supposed to have your hands on the wheel, all of that. So this, what's going to be a software update forced to every Tesla on the road, is going to require drivers to be more attentive when they drive their Teslas down the road in those self-driving modes. So that's what's up with this Tesla recall. We have Tesla on our Wookiee watch list. So when this news came out, it made its way into our newsletter, even though you've probably seen it already on Twitter.
Yeah, I think we'll see what ends up happening. I mean, Elon Musk is very much like the orange guy, been bulletproof from prosecution thus far, even though in that famous 2016 video where they tried to purport that full self-driving was effectively here, which obviously fast forward to turning into 24 in a couple weeks, it's still nowhere close to commercialization. I mean, really, the issue is that people, and we talked about this several times, so I don't want to belabor the point, but that there's just such a difference between advanced driver assist systems, which have statistically proven themselves to reduce risk, reduce likelihood of crashes, automatic emergency braking, lane keeping, adaptive cruise control, insert, whatever system you want here. Those levels of autonomy, though, level 1, which has one of those systems, 2 has more than one of the systems, 3. The issue is that autopilot is a level 2 ADAS system, but the way that Elmo Musk has portrayed it is quite different from that. And while it may be an effective ADAS system, it really hasn't been pitched that way, which is different than the full self-driving software that they've been selling for upwards of a decade now, despite that product not being in existence. So it's, we'll see. I mean, it looks like there may be some more regulatory pain. I mean, but I'm not gonna get my hopes up. that the Democrats are going to do the right thing with Elmo. But we'll see. I know everyone is obsessed with Tesla. I'll just be happy when it finally deflates that bubble. It's trading at a 71 times forward earnings. Usually these companies have earnings growth. In the case of Tesla, earnings are actually declining. They're estimated to decline 22% for the full year of 23. So usually when companies have extraordinarily rich valuations, they're growing earnings. This is not a company that's even growing earnings. But yeah, the fan club will continue to believe in what Elon pitches to them, it seems, until he is forced to stop breaking the law. We talked about the Fed a lot on Wednesday. I had I don't know if it was like a 15-minute rant, so I'm not going to repeat that today. But I thought that Steve Sosnick, who I think is a must-read, he's one of my favorite kind of market strategists. So just follow his takes on things. I think he in his note today, the headline is Powell spikes the punch. And I think that's exactly how the market received the Fed dot plot as well as the Fed presser on Wednesday. That instead of pulling the punch bowl away, as the Fed is supposed to do, Sosnick makes some comparisons to what happened in 98 and then into 99, 2000 with the blow-off.com top, and the notion that by spiking the punch bowl, by not taking it away, that there's a prospect that we're going to have a repeat of that. Yeah, I'm not sure what they're seeing that makes them feel like going out to the market and convincing it that there's 4, 5, 6 rate cuts coming next year is the right thing to do. But yeah, so it wasn't Sosnick. It was last night's Points of Return by John Authors at Bloomberg. So I'll kind of just read off what I have on my screen here from his write-up. He says, he leads in melt up ? If there's a risk, it's that the Fed has repeated the crucial error of 1998 when the meltdown of long-term capital management and the freezing of capital markets prompted rate cuts at a time when the economy seemed to need hikes. The result was the biggest melt up of the stock market in history. Well, gravity is real. Fundamentals are real, even if they don't matter much in the short run. So when you juice things in excess of fundamental value, it just makes the hangover that much more painful on the downside. So we'll see, right? Timing is everything. So if you're if you're moving in and out of markets, that's timing is everything. If you're not, then the price you pay is much more important. So we'll see what happens. I mean, I'm kind of in line with Sosnick and Authors in the view that this was a mistake, that the Fed should not have come out and given the green light. That the party we're gonna keep the party going. But equity markets overreact. It's what they do. They're optimistic by nature. So we'll see what happens. That it just seems crazy to me to think that the Fed is gonna loosen policy so much so when financial conditions have already eased massively over the preceding month and a half since rates peaked. Since the 10-year nudged up on 5% now. This afternoon, we've got the 10-year on par with the 5-year at 391. So, 3.9 is to me is not a very tight 10-year yield. I mean, in the context of the last few years, sure, but in the context of the long run, in the context of if the Fed truly believes that the long run, neutral rate, if you will, is around 2.5%, then it's not yes, it's a positive real rate with where inflation is, but it's not that tight. And yes, the term rates, of course, Fed funds, which a lot of smaller borrowers are more impacted by, is a little restrictive. So we'll see how it pans out. I don't know. Very, very skeptical. It seems like this was waving, as I said on Wednesday, this was like Bush showing up on the aircraft carrier, unfurling the mission accomplished banner, and things have not been won because prices are not stable. Consumers don't think they're stable. And the Fed had made it clear that you cannot have full employment without stable prices, but it seems something changed their mind in the last few months. So see what happens. Joe, do you want to talk about the
The next
Epic
story here.
Games story?
Let's see. Yeah, so I think a lot of people have been following this one. Google's been defeated at the hands of Fortnite maker Epic Games. So Epic Games obviously created a very sensational empire with Fortnite and is not happy that 30% of all transactions on any app on the App Store. This is same Google and Apple. I believe they both have similar splits of about 30% or more. And yeah, Epic's not happy with either of them. Epic wants to be able to sell their microtransactions without giving such a hefty coin over to Google or Apple. So Epic's been fighting against this practice for a long time, and they finally got a federal jury to agree that Alphabet's Google has been acting unfairly and as a monopoly. So, the chief executive officer, the CEO, Tim Sweeney of Epic Games, is quoted saying the dominoes are going to start falling here, and the end of 30% is in sight. So he's optimistic that he can change this ruling. Got to say, what a bold undertaking of them. Most platforms just opt to request their customers to sign up elsewhere, like signing up for Spotify Premium can only be done on the website, and then Musk's rendition on X is to charge 30% more if you sign up on the mobile app. So typically, that's how other people have fought this. Epic decided instead that they would, champion a legal movement to take it down instead, and it looks like they're got a pretty good chance of making this happen. So, cool stuff. Rod, I don't know if you have any thoughts on that.
Yeah, I mean, I've actually never played Fortnite, not once. So I don't think I've ever played an Epic game, but they've been butthurt about the fees they have to pay for a long time, and they took them to court, and they're going to win. It looks like they've won versus Google. So I think the read through is in the Wall Street Journal story, kind of one of the analysts talking about the impact to Apple's services business, because as they put it, the majority of Apple's services business is essentially selling access to its user base, the folks who have iPhones or iDevices, and then taking a cut of App Store sales, or taking billions of dollars from Google for them being the default search engine, etc. So like that's what the services business mostly is. So if you're going to see a structural change in how much of a toll they can take on every transaction within their ecosystem, then it's not good, because investors have bid up Apple and many other stocks to extraordinary valuations. Apple trades at a 30 plus price to earnings on a forward basis. That's very rich, extraordinarily rich in the context of their earnings growth. So the price to earnings growth rate, you can see if you're looking at my screen, let's not include pre-iPhone era. Let's go around to like '08. You can see that Apple's PEG, they've always, let me not say always, over the last 15 years, you can see from the chart that we're close to the highest price to earnings growth multiple that anyone has paid for Apple. So either earnings growth is underestimated and earnings growth is going to come in stronger than expected, or the multiple maybe is a little crazy. It's a almost $1 trillion market cap, and it doesn't seem like it's trading much on like intrinsic fundamental value, perhaps more so about just passive investment flows. But Apple, again, but for a brief moment toward the end of 2020, early 21, Apple has never been more expensive on that price to earnings growth measure, at least not in the iPhone era. I mean, look, it was a much, much, much smaller company pre-iPhone era. So, yeah, I mean, I don't get it, but I don't get a lot of things. I'm just an idiot. So I think it's bearish read through for Apple and for Google, but the market doesn't seem to give a shit. Now, this one I thought was interesting. The Shohei Ohtani contract. I'm not sure how many folks here are baseball fans. I don't care about baseball, but I was curious when I saw the headline come in of this baseball player getting a $700 million 10-year contract. And it reminds me of a conversation that we had a few months back when we were talking about interest rates and the changes on like those headlines you hear for lotteries. You hear the Mega Millions, the Powerball, whatever, and it says, "Oh, the lottery jackpot's up to $1 billion." Well, not so fast, my friend. That $1 billion headline number would be the nominal value of receiving equal payments over maybe 20 or 30 years in terms of those lotteries. So you have to discount those cash flows, and with the change in rates, we have a discussion around that. So the way that this deal was structured was quite interesting. Joe, I know you included a tweet from somebody talking about it. He was, I guess, talking about it in the context of a normal deal, assuming, say, he was going to get, $70 million a year over 10 years, and just highlighting how much in both federal and here's the highlight. Well, it's both federal and California. So I actually don't know if Ohtani has U.S. citizenship or not, but I think that the read through on the way this deal was structured is that he is confident he will not be in the United States in 10 years time, or in 11 years time, excuse me, because the way this deal was structured is that not the 70 million per year. He's actually going to get $2 million per year for the first 10 years. So that other 68 million
20.
per year.
You said 2 million. It's 20 million.
He's going to get $2 million per year over the next 10 years. And then he's going to get 68 million a year over the 10 years following that. So it's a really curious structuring. Yeah, it's 20 total. It's 2 million per year of the 70 million per year that he's going to actually get in each of the next 10 years. So why is he doing that, and what are the implications? There were a few different stories written about it. I saw Matt Levin refer to it in his newsletter yesterday. So let me put that back up on the screen here. We're talking about like what are some of the different considerations and risks, and why would you do this deal? If you're Ohtani, if you are the Dodgers, for one, as Levin points out, and as I was trying to get to, a secondary reason is I guess that Ohtani will be earning $2 million a year while living in California and paying high taxes, and then he will be earning $68 million a year when he no longer needs to live in California and can pay low taxes. One reader suggested to me that California should try to tax him now on the unrealized upfront value of his contract. Well, that would be interesting litigation. But it's again, not following baseball closely, not knowing the ins and outs of like baseball's luxury taxes and how they structure that. I mean, that's a separate conversation I won't even entertain. But to me, it's more interesting that this player is so confident. Is a Japanese player, right? Somebody who's accustomed to, who lived his entire life presumably in a zero inflation world or a very low inflation world. He was so confident that he's willing to defer $680 million of that massive windfall for 10 years, for years 11 through 20 of his of this time, right? He's going to be earning the money when, what if he might retire at the end of the 10-year contract. He might be in retirement and then earning $68 million a year for 10 years. The net present value though of those cash flows is, what is the discount rate, right? So he's pretty confident that we're not going to have a big bout of inflation, it seems to me, by deferring all that compensation. He's also pretty confident that wherever he ends up living, I think at the end of the first 10 years will be a much lower tax domicile than California. So I thought it was really interesting to see, because I saw the headline. I'm like, wow, $700 million for 10 years? That's insane. But when you really consider the uniqueness of the contract, it's more like in the mid 40s per year, which, nothing to diminish, but at least from the math of baseball's collective bargaining agreement, that's what the Dodgers have to fund starting in 2026 is $46 million a year. So you've also got the consideration, if you're Ohtani, of what happens. Look, the Dodgers, I'm a New Yorker. I remember the Dodgers, played in New York many, many, many decades ago. So presumably the Dodgers franchise is not going to go away in 10 years' time. But what if? You're bearing that credit risk, right? If you're Ohtani, you're an unsecured general creditor of the Dodgers if they don't pay you. So 10 years from now, giant earthquake wipes out the entire Dodgers organization in Southern California. Mr. Ohtani may not see his, he may be in a bankruptcy court fighting for those, remaining $680 million that he's owed. So I don't know. It's just a curiosity, one of those things that combines sports plus finance. Thought it was interesting. I don't know if anyone else has any thoughts on that one.
Some good points there, Rod. Definitely wasn't even considering the possibility of the Dodgers not existing when the time comes to be paid out. That would be an incredibly unfortunate situation for him. And also not a zero possibility. Things happen. Plenty of sports teams have dissolved. So definitely a risky move. I think the way this is structured is strange, right? Like, what's the value of this contract when the time comes to be paid? What is $600 million going to be in 10, 20 years, right? Definitely unique. I think it's quite the headline number. I've never personally looked into him at all. This is for seeing this contract was the first time I've heard of him. I don't really follow baseball too closely, but look, he's only up in LA. I'm here in San Diego. When I heard about this, I told a buddy, let's go up there, let's go see a game, see what this is about. So when he's playing in LA, I'll check it out and I'll report back and see if it's worth it. See if he added that much value to the team.
So I opened up Excel. I'm gonna plug it in with some different discount rates and see what it has to say. But in this case, there's just such a huge swing in the value of those, that 680 million that comes in equal installments in years 11 through 20, right? Yeah, I'm not going to be able to try and multitask, and I don't think anyone cares. But either way, it's curious.
How's it going, Psych?
Yep. How's it going, guys? Funny enough, I actually do have a personal connection with Ohtani. I went to school with his translator, so I'm kind of curious. I think they upped his he's in the contract now. Do you guys know how much he's getting now? It's 1% of donations, something like that. I haven't read through everything my friends did, but it's kind of interesting to listen to about his translator Ippei Mizuhara, who's he's a really cool guy. If you guys ever meet him in real life, so.
Well, that is cool to know. I'm reading now, and there's the AP reports that he can opt out of his contract if either of two key executives is no longer in place. So it looks like he'd be allowed to terminate his deal if Mark Walter is no longer controlling owner or president of baseball operations at the Dodgers, or Andrew Friedman is no longer with the team. This person apparently spoke on condition of anonymity.
So I put together just a little simple NPV calc on the 20 years of cash flows. If we assume 4% discount rate, which I think is pretty low, but let's use 4%. That means that 700 million nominal value. Again, this is all pre-tax, and the tax is a big, I think, angle here for him. But pre-tax, the net present value is 389 at 4%. Bump it up to 6%, and you've just lopped off almost $100 million of value. Take that all the way up to 10, and now that 700 million is really only 174 million. So, because of how backloaded the cash flows are, they're especially susceptible to the discount rate here. So, I'm pretty confident that we're not going to have a bout of wild inflation here for Mr. Ohtani. But I mean, look, no one knows. So I think it's just interesting. Either way, I think he's going to be A-okay because even if we get runaway inflation, and we get he's going to have millions of dollars. He'll be all right.
I also want to add, I think like Ohtani makes about like 25 mil off his sponsorship deals just like in Japan alone. I don't know what he's getting like here in the States, but yeah, like even with like the 2 mil that he's getting from the contract, he literally does not need that 700 mil for a very he doesn't need it right now. But yeah, he's good.
For sure. But that was all we had in the prepared material. So it's 4:33. As we said, as Joe said at the onset, this is our last broadcast of the year. I'll be taking the balance of the year off. So yeah, anyone wants to talk about any of the topics we brought up? One thing we didn't bring up, obviously it happened this morning that didn't make the newsletter, is the events. I think this is now the third week that we've been talking about it, so it's not like it's new news for anyone who's listened to us. But the events in the Red Sea, the attacks in shipping lanes there, you've now got 2 of the top 5 container shipping lines, Maersk and Hapag-Lloyd, that have opted to route their ships around the Cape of Good Hope, around South Africa, to avoid Suez and avoid the Red Sea. So we had talked about how you have the El Nino, whichever one of those weather events it is that is impacting water levels in the Panama Canal and causing more ships to have to sail around Cape Horn. So these are pretty big disruptions. We'll see if it escalates further in the Red Sea. Is it going to impact shipping non-container? For now, I've seen a lot of the oil tankers that are traversing that shipping lane still appear to be headed towards Suez. But look, that's a real disruption. I mean, all else equal, you figure if you have to extend your shipment time by 2 weeks, 3 weeks, in order to skip the canals because you can't utilize them, and that's adding cost. It's adding inflationary pressure. So we'll see how that all pans out.
Yeah, actually, I kind of want to ask you guys about this. I don't know if you guys follow Zim shipping at all. Like, it's literally shot up a little under 20% today. But are they affected, or did they go up because either A, the rate cuts, or B, the fact that Maersk or some of the other shipping companies are affected by the Red Sea, that money is moving more into other shipping companies? Or what's your guys' thoughts on this?
I mean, Zim had gotten really, really beaten down. So I don't know if the reaction today is purely related. I mean, the stock jumped, I think, after the announcement. So I don't intimately know the shipping industry dynamics to know how Zim benefits from this impacting Maersk and Hapag-Lloyd. But I mean, Zim is still down 43% year to date. It's still far off at the highs. So like part of it is that like many other kind of smaller cap stocks, uh, before Powell, it was trading at $7. So it had already jumped, 15-20% post Powell. So I don't know how much of it is some idiosyncratic benefit that the market expects them to receive, and I don't know enough about their business to isolate that. Yeah, sorry, I don't have a better answer to your question.
Yeah, it's all right. Like I don't know, like I just saw a post about like Zim. I totally forgot about it. Like I remember like back when like the shutdown and the pandemic happened, like they were giving like ridiculous dividends. Like they were giving like 70-80% dividends, like the yield for that year. And I mean, then after that, like it just started like tanking. I mean, like I
No
think
pun
like a big part
intended.
of it.
I mean, Zim IPO'd right around the peak of all of this, right? Early 21. It's like Zim, like many companies, I think was opportunistic in when it came public, and therefore, if you look at the max chart, you got the build throughout 21. It peaked at $85 in March 22, and as normalization of supply chains has happened, the stock's down almost 90% since then. So it's still below the IPO price. Again, I don't know the business intimately, but yeah, I mean, if you don't know shippers in and out, you probably shouldn't just jump into them because of some geopolitical events.
Although, what was it like? I think I did see a post from Calvin Trowledge. Like I know he runs Marhelm. He was giving a map about the fact that they need to use the Suez Canal because going around Africa is like what 15,000 miles around just to get around. But we had like a similar event about like 2 years ago, didn't we? Where the Suez Canal was blocked because of a shipping boat got wedged in between, and then I don't know, my guys might have talked about it then about the risk of rising prices for goods going that are being shipped. Like it could have a factor with inflation, right? Or I don't know if we'll see any noticeable uptick or not. So
Yeah,
any thoughts?
I mean, I think this is the third week now that we're talking about it. So we talked about it last week and the week before. The impact of the canals. I talked about it in the intro. I don't want to repeat myself again, but yeah, I mean, if you're adding a couple of weeks transit time to shipments into Europe or that are going to traverse Suez, and then you've obviously got the exacerbating drought issue for Panama, and that is an even longer incremental transit to go around South America. Yeah, all else equal, that is meaningfully adding cost and adding inflationary pressure. So I don't think anyone who isn't embedded with the Houthis knows how much more attacks they plan. But as reported this morning, Maersk and Hapag-Lloyd, at least for now, are are going to be sending their ships around, either waiting a couple days to see if the smoke clears, so to speak, or beginning to route themselves south around South Africa. Yeah, you're right. That had happened when the Ever Given got stuck in Suez 2 years ago, or whenever it was. Time is all a blur to me now.
Yeah, it just seems like yesterday that it happened. Kind of trippy how fast things went by since then.
Yep. But yeah, anybody else listening wants to request to speak, chime in, ask a question, change the topic, feel free. Again, this is our last book and review of the year. We're going to come back next year and see if we keep doing these.
I got one more before I'll switch down to listener. Is this small cap rally sustainable? It's kind of like crazy how high things just went up right now, even at the peak of rising rates. I mean, like for the Fed to project, what was it like? They were only projected to do 2 cuts, but now they're possibly adding in a third cut or projected third cut. Did something happen with like Powell that he saw something break and spook him, or do you have any ideas on this? And then I guess like the small cap rally, is this the Santa rally, and then like we're gonna see like a sell off in like about a couple of weeks or a month, if you think?
Yeah, I mean, I went into this in like a 20-minute rant on Wednesday, so I don't want to repeat my rant. I mean, it's the essence of your question. Small caps are not that richly valued. So there's no reason to think they couldn't continue to rally. It would seem like the impetus has been to shift into higher risk, more interest rate sensitive securities like smaller caps than, say, the mega caps. I mean, IWM, the delta from pre-Powell to post-Powell is 600 basis points, whereas for the Nasdaq, it's like a third or less. So I think if this continues, this view that massive cuts coming next year, soft landing, then I would think there's a lot more room for small caps actually to go up, given how poorly they've done. If you zoom out, the S&P 600, which I prefer to the Russell because the Russell has so much dog shit in it. The S&P 600 small cap index, over the last, it peaked in November 21, and it's still more than 10% shy of that level. So, small caps. I'm overweight small caps. Just generally, I invest in smaller caps. I would tend to think they have more upside than the larger caps who've already seen extraordinary runs, but I don't know anything.
Gotcha. Thanks for that opinion or outlook or thoughts.
I mean, the main thing to kind of think about is that the smaller cap companies, all else equal, the smaller the company, the higher the mix of variable rate debt. So larger companies are going to have generally both longer dated and more fixed rate debt. Then smaller companies are going to have shorter dated and more variable rate debt. So the benefit of rates and of the forward kind of curves coming in is felt and is more real. And if you think about a lot of these smaller caps that maybe they're heavily levered, maybe there was going concern risk or whatever priced in, like those are going to be the ones who rally the most. And I think that's what we saw. We saw a lot of the shittiest companies surging on Wednesday after the news, right? It was not the best companies in the world. It was, maybe the stuff that had gotten beaten down a lot, and is disproportionately going to benefit from rates coming back, in from these somewhat restrictive levels. So, yeah, I mean, the notion that there's like something in the data that spooked Powell and Yellen, I don't know. I don't really know that I believe that one. I do get the notion too that you have an election in November. So if you are going to be doing any cuts, and again, this is, a 5, where the Fed funds rate now is restrictive. The short-term overnight lending rate is certainly restrictive. So if they feel confident, as they clearly do, that inflation is on a path back to stable prices, and that they maybe have to look and are now more concerned about the full employment side of their mandate, then preemptively loosening the restrictive level of policy does make sense. And that's perhaps why they're going to front run it or front load it kind of starting in March, is what the market thinks. I hadn't looked yet today. It was like a 10% chance when I looked yesterday of it being in January's meeting. That seems, unless something in the next few weeks big to the downside happens, some global shock, negative shock, maybe this, maybe if Suez is kind of shut down and the situation in Panama, who knows? So, yeah, I mean, they would rather not be cutting rates right before the election, right? They don't want to be viewed as having their thumb on the political scales. So that muddies things. I think if there were not an election in November, then they would have been a lot less, of juicing the punch bowl, as it seemed they did. But yeah, hey Rocket Randall, and Sick, I guess drop. Oh no, I see you see a listener. Okay, cool. Hope that is a good answer for you.
Hello, Mr. Alsmith. Is my mic working?
It is.
Oh, nice. Okay, I couldn't tell. I only just came on here to say that over 1.9 million ITM calls expired on SPX today. And it was like, I think 1.2 million calls on QQQ. And that as a total is 39.5% of SPX's ITM calls and 38.7% of QQQs. So I'm hoping for big downs next week. I don't know if anybody else is, but that's a huge amount of delta that just fell off the indexes today. And there wasn't enough volume, like on these ITM calls, to actually cash settle them today and to close. So they were held right into the expiration. And that's pretty much it. I think this might be the end of the pump.
Maybe. Yeah, I don't really follow that stuff, so I don't have anything informed to say. Don't pay attention to it. Sorry.
Well, I pay attention to it. That and Apple fell at the end of market close today. It's down $1.08. I don't know why that is. I didn't see any news.
Buy the dip.
No.
That's sarcasm, folks.
Yeah, no. I don't know. I don't think there's actually anybody buying. I think this is all just driven by derivatives, is it not?
There's rampant buying from the trend followers, if you believe Goldman.
But I don't believe Goldman. When they put out those high conviction ratings with like Nvidia, and didn't they do one for, was it Meta too or Apple? It was one of these. There's two of these big tech stocks that got the high conviction rating, I think, from JP Morgan. And then Goldman did the Nvidia one, like I think 2 months ago.
It's not just Goldman. I mean, everyone expects that I've read. I just was using Goldman, but if you'd prefer me just say everyone I've read expects that CTAs will keep buying because things have gone up. So, I mean, you do have a shit ton of retail buying. I think I'd seen a few sources cite pretty extreme levels in terms of percentile, and having to go back to like some of the extreme levels of 21 for like retail inflows. So you just have a shit ton of people buying. But it goes back to are the it's to me it's like the always has been meme is like it's just multiple expansion, always has been. These like Costco, I think, is a good example. It's like it's a wonderful company. I love the company, but well, this is a company that's trading at 40 now 2 times forward earnings, and going back to the price to earnings growth to kind of show you how rich that is. Costco's price to earnings growth now is an all-time high. It's north of 5. It's richer than it was even during the peak of the bubble. So there's a lot of companies that have just gotten bid up like crazy. The fundamental justification is not there, but it doesn't mean that the bubble can't keep going. I mean, it goes back to what I started with in the conversation, that if the market is viewing this as the punch bowl being juiced and the A-OK to go full risk on, why wouldn't we get a repeat of 1999, where we just get complete lunacy? And it's been frustrating for people who are more value-oriented investors, and unfortunately it may continue to be frustrating because I don't think that people care about margin of safety right now.
Well, I'm with you. It's been totally frustrating for me. I started buying puts in September, and I didn't take a lot of profits. Even when we bottomed out there in October, I was up on like almost all my positions, and I never took that much profit. Now I'm just like 90% down on everything, and I just keep still buying more puts, short dated ones, unfortunately. And I think we hit a breaking point today. It's got to come down at some point. And this was a really, really, really big monthly options expiration. I don't know if they're going to be able to hold it up this next week unless they keep buying again. More calls, more leverage. But I just don't understand the narrative that the stock should go up because of a rate cut. I guess if inflation is soaring, it would make sense that the market would go up, right? Like it does in every market. But according to their numbers, it's not soaring. It's what, 3%. So I don't know. It's got to come to an end at some point. And
I mean, the move in yields is very real and has a very positive impact on valuation. If you knock your risk-free rate down by 100 basis points, that's going to expand the value of the firm by, depending on the firm, it's going to expand the value of the firm by definitely north of 10%. Could be pushing up toward 20%. If you go from 5 to 4 on the 10-year and you use that as your risk-free rate, so like that's a real benefit, a boon to valuations. But again, from a sustainability perspective, like I don't see how you underwrite, the 10-year now going from 3.9 down to 2.9, and how much more of a benefit you get there. Like that doesn't seem likely to happen. I think I saw there's a divergence where Bill Gross had voiced a view that he thinks the 10 years it's already run farther than it should have, and that he feels like around 4, possibly even just north of 4 is where the 10-year ought to settle. But Gundlach thinks that it could run down to 3. And if that happens, then why wouldn't the markets run up another 10, 15, 20%? They would. They probably would. I mean, who knows? If it's running down to 3% because there's some massive exogenous shock that's wiping people's sentiment down, then perhaps equities are also plummeting, even with yields plummeting. But in the absence of, there's just not enough to scare people. People do not have fear. I mean, you look at the sentiment survey data and you see the level of bearishness at extraordinarily low levels from this, from the respondents at least, and the VIX index being below any level. Got to go back pre-COVID. So just a lot of complacency, lack of fear, and then of course it's December. So as I mentioned, I'm going on vacation, so I won't be. There's a lot of people that go on vacation. I think volumes fall off over the next couple of weeks, and we'll see what happens as we get through the rest of potential, some noise from tax losses in certain securities. But I would be inclined to think that there's a lot of selling in January, February, just like on the, we had a lot of buying in January and February of this year after a big down year. I would think that after a big up year, you'll have people not wanting to lock in their taxes and having to pay them come April 24. They'd prefer to sell in January and then prospectively not have to pay their taxes till April of 25. And it's like, well, if everyone knows that, isn't, but that's things don't work out that way. So my thoughts would be pretty drifting upward through year end, at least index wise, probably, unless something new enters the picture, and then I would think that you begin to see some of that profit taking, and then it's like the sentiment just follows price. So if prices start dropping, do people start to panic, and then does price overreact? I mean, to me, that it's just extraordinary to look at the steepness of the move from October 26th, which I think is when the 10-year peaked. So you cannot repeat that move because you cannot repeat the 10-year going from 5, and dropping 110 basis points in 5 weeks, 6 weeks. That's not going to happen again. Famous last words.
It seems like a flight to safety to me. Like the move is so exaggerated, it doesn't make sense. Like even with
No, it's been a dash for trash. It's been the opposite, I think, is my view. People have been bidding up the lower quality stuff. They've been willing to sell quality because qualities and like perceived safer assets like the mega caps, I think, have been the stuff that people have been hiding in. And now I think the Fed's given them the green light to shift away from the Apples, Googles, etc., and buy some of the beaten down, hairier stuff. But yeah, that's just my perspective.
Well, I've seen those new articles and the line dash for trash, but I think it's just propaganda. I don't really believe it.
I mean, that's what, when I look at my watch list, it has been trash that's gone up a lot, not quality.
Yeah. And well, just to move in treasuries, though, I'm assuming is a flight to safety. Like I can't remember. I don't have the dot plot in front of me, but I think the rate cut for next year is going to be like 0.75.
I don't know that it's a flight to safety so much as the Fed appears to have wholly abandoned higher for longer. Therefore, that's the green light to buy longer dated bonds because there's less of that risk that the Fed is going to continue to keep this inverted curve in place due to maintaining the short end higher. So yeah, I had been of the view that we had not seen the high in the 10-year, but as the market has humbled me all year long, it has humbled me again, and perhaps we have in fact seen.
Well, that confuses me too because I thought Yellen had announced that she's going to sell 1.6 trillion in treasuries over the next 6 months, mostly next year. Like you would think that would have some effect on the market too, right? Where the yields would start pumping, but it hasn't. It's done the opposite. So that's part of the reason why I think it's a flight to safety. I would assume if the market were to react to that kind of news, they would, want to short bonds if anything. But it's my understanding there's already large short positions out there in treasuries, so maybe they're just trying to close their shorts before repositioning. I don't know. But anyway, I'm hopeful next week that Tuesday we'll see a big move down to reflect what happened today with the options expiring. So we'll see. That can be totally negated though, but people keep buying call options, but and selling put options. But we'll see.
Yep. So it's 5:02. We started about an hour ago. We walked through all of the prepared material. At this point, it's just kind of floors open. If anyone wants to chime in on their thoughts on any of the material we covered, ask any questions, could be on a take it in another direction, feel free. I'll probably wrap up somewhere in the next, depending on how much people want to discuss, somewhere in the next 15 to 45 or so. This is a good, for anyone watching my screen, this is a good graphic. It's the delta between the forward price to earnings ratios of the Russell 2000 and the S&P 600. And I mentioned earlier how much I don't like the Russell, and it's pretty extraordinary. You know, the Russell 2000 forward PE is almost 22, but the S&P 600, on the other hand, is only 13.4. There's within the universe of small craps, there is a pretty broad disparity. Like when you look at the S&P 600, PE, it's almost akin to GFC washout levels. So, again, I've made the point of several times in this discussion and elsewhere that the delta between large and small has again exceeded the dot-com peak. And again, my view is that the large caps must thus underperform going forward. But for now, everyone and their uncle wants to keep buying them.
Psych, requesting to speak again. Why don't you come on up?
Yo, so I guess like since this is like the last book and review before you guys all go on vacation, what do you like? How do you see the economy and then like the market looking next year, like first, second quarter, or like patterns that you've seen, or like you feel that's going to be happening again, maybe? Or like I know none of us are like fortune tellers or anything, but from your experience with what you've seen so far, and then like going through these rate hikes and rate cuts, any thoughts on how things in various markets might react? Like I'm pretty sure you might have covered it Wednesday. I was like I couldn't hear everything, so just wouldn't mind a recap on your thoughts.
I would say, look, it's a consumer-driven economy. It continues to be a consumer-driven economy. It will always be a consumer-driven economy, at least here in the United States. So watch as we get through this last week or two into Christmas. The November retail sales were above expectations. So the consumer resilience, the willingness to spend, capacity to spend, like looking at, you'll get from the credit card companies transaction data. And if you start to see, because I had been of the view that the consumer was going to really start to pull back on that spend as they run out of surplus savings. They have incremental obligations like student loans that are toggled back on. And so far, this holiday season. It feels as though people have been willing to continue to spend, whether that's debt fueled or buy now pay later fueled. Perhaps, you know, makes me a little worried about the longer term durability of it. But yeah, I mean, looking at consumer spend, and really, as long as people have jobs, they continue to spend. So given that the labor market is still pretty strong, look to see if you see, a big, initial jobless claims print sometime in the next, weeks or months. Like starting to see cracks in the labor market that we clearly haven't yet seen. At least, there's weakening, and there's been ongoing moderation of labor market, but it still feels like a pretty great labor market all in all. So, if you start to see labor market cracks, you start to see data points showing that the consumer perhaps has run out of capacity to spend, that would be worrisome to see. That's kind of what I was expecting we'd start to see, and we've just not seen. But again, it's hard to argue. The fiscal deficit is extraordinary. It's like we're running wartime levels of deficit spend here. But this is supposedly, a wonderful full employment economy. That is, it's hard to reconcile some of it.
Well, that all brings up the next question. Which sector of the labor market are you seeing cracks in? I don't know. Maybe like I got like a weird outlook on stuff, like the way that we've spent during the pandemic, and just essentially some of the stuff that's been happening. I don't know. Like I'm probably totally wrong on this, but it's kind of like akin to like post World War II, where now some of the sectors that weren't so disciplined in their like capital spend are going to have trouble, but then it's going to be shifting into like other companies in the same sector. By what I mean is, like, for instance, let's say hypothetically, Disney, like they went through a big round of cuts earlier this year, but then like now I'm just hearing through the grapevines that like other studios, kind of like let's say Paramount or like Netflix is, probably going to be more expanding, or going for, they're going to be spending more on some of the projects, and just essentially the money and then like labor is kind of shifting from company to company versus actual cuts at the moment.
Yeah, I pulled up the last real-time economics newsletter from WSJ when we had last Friday's jobs report. So like some of the stuff that's, I would have thought the Fed might have had some worries about was like some of the upticks in pay in November. Some of the kind of, the Fed had made the point, Powell made the point throughout the year that wages are increasing at a rate not commensurate with stable prices. And as I see it, those rates of wage increases are still not commensurate with stable prices, assuming that 2% target. So wages further cooling would help the Fed. If we keep seeing wages running hot like this, then it's just there's a disconnect. You cannot have your cake and eat it too. Like when I think about certain sectors, though, like you've just continued to have this big expansion of labor in, like, think your kind of services, your wait staff, your bars and restaurants, that sort of stuff. And that led the way again in November. So that, to me, if you see that spending, willingness to spend, capacity to spend, and some of that, and thus labor, like pull back there, that would be the sign that the consumer is out of gas to me, because that services spend has continued strongly for almost all of the year and last year, really. But that would be something I'd be looking for. And there was a lot of noise in this last month's data because of, you mentioned Disney. Think about the auto workers. You had a lot of people coming back from strikes that get counted in employment gains for the month. So a little bit of a noisy report, but I've talked about the industry I know the best, transport, and I thought I'd shared it. I don't know where it is, but the notion that there's still a lot more pain and job losses to come in, like, for truckers, there needs to be more of a purge of capacity. There's just too many trucks chasing too little freight. And I shared the Cass freight index, I think, on my Twitter yesterday, that came out. And when you look at the data, shipment volumes are we called it a freight recession in 2019 when shipment volumes were at this level, and shipment volumes are at this level again. So the real economy, there's a lot of noise in different sectors, and if you just look at the stock market, you would have it's completely disconnected from real economy to me.
Okay, and kind of wanted to touch up on the services sector a little bit. Like I know that's like nationwide, and maybe this is more of what's the term? Stuff that I've been seeing. I mean, like a lot of restaurants that I see like around like the SoCal region, like they're still looking for help. Like wait staff or just like at restaurants that, like what you said, waiters and stuff. They're still hiring because like they still haven't recovered like their empty slots. Would that be factored in? Because my friends that also are in that sector, either they have a restaurant or they work as a cook or something like that. They need more help, but apparently like it's still pretty empty for them. And like, would that be another factor, that there isn't enough labor for that specific sector? And maybe I'm hoping that you can give us like a run through of like how that services sector is calculated, that number that you talked about.
Which number?
The services sector that you were talking about, the waiters, the spend for like bartenders and stuff like that.
I was just saying that the food and drinking places category had the most job ads. I think for much of the year, it's kind of led the way. Yeah, sorry, I don't understand the question.
No, I think that's it, because like I was under the impression that a lot of these restaurant and bars and just places of food and drink needed more staff because there's still a lot of slots empty from like 3-4 years ago when the pandemic happened. So like we're actually now reaching recovery this year. Like, so wouldn't that be more of a bullish sign or like a neutral sign versus something to look out for? That like we're actually still recovering even now, up till now.
Yeah. That makes sense. I mean, if the restaurants that are still operating at below capacity because they can't find a supply of labor, then yeah, you would think they're going to keep trying to hire and keep hiring so long as the demand is there. My concern is that I think that just like we had a whipsaw of sorts on the goods sector where people bought everything they could fucking buy when they couldn't spend on services, now the opposite is holding true where people are spending on services. And I think that hangover begins to take effect. And we see the demand not continue up in one direction and it starts to dissipate. And that's when you start to see that there's a mismatch of then perhaps you have too much supply of labor relative to moderating demand. So I don't know. That's my view. I'm probably wrong.
Do you have any historical examples where something similar happened that you're looking for that you could think of?
we only had one pandemic a century ago, so no, like there's not anything comparable that I can think of.
Like, I mean, like within the last 30 years, there was where people wanted less goods but more services. Was there ever like a year that we should look into?
Oh no, there was nothing like what happened ever. I mean, it we've never shut down the economy, the global economy, like we did. There's no comparison that I can think of. Maybe somebody else can.
Gotcha. Thanks for that take. I'll switch back down to listener again.
Yeah, I'm short a few stocks that relate to that view, like Royal Caribbean, for example, the cruise line. Like again, you got a lot of these heavily indebted companies that are basically, in my opinion, kind of getting all of that revenge spending, and people just like they did with Peloton, they see this big uptick, and then they just underwrite that that's going to be the new normal, and that's kind of where I guess kind of a corollary that I'd draw between my view on where services spend has gone to and will go to, and where goods spending went to and then drew down from. So like you've heard a few, I think it was Walmart, at least calling out that in certain goods categories you'll see deflation, and it's because of demand, moderating, the supply then being there, and then prices declining due to that. I think you can't draw it one for one with goods and services, but I think services is going to have that. It's going to feel that in 24.
Cohort 101 requesting. How are you, buddy? Brought you up. You're going to be muted.
Hello?
Hey, how's it going? How's it going?
Good, good. Hey, Rob. Thanks for doing one last space this year. Um, I want to just talk about or point out one thing that's been very different. You've been pointing out some things that have been very different about this cycle, and that is construction labor. And that is typically reliably one of the levers that the Fed, when they raise the short end, that they can typically depress construction labor, but construction labor has remained at an all-time high, and then is kind of residential labor actually has rebounded in the last couple quarters after a little bit of a dip, and so is like if you look at the last, well, obviously '08 is an outliner, but all the other times they have raised rates, the construction labor as mortgage rates and interest rate rise, the guys on the job sites slowly get laid off as work dries up, and then the economy slows down, and then the Fed, as the economy slows down, they can drop interest rates, and then people start hiring, starting new construction projects, and we have remained at an all-time high in labor for the past like 3 years in construction labor. So I guess I know Rocket and I have been talking about home builders because their stocks are all-time high, and we're at an all-time high basically before the Fed soft pay it. And so I guess I'm as confused as you are as where we are and where we're heading.
Good. I'm glad I'm not the only one. Yeah, I mean, like, and then I don't know. I follow a lot of housing-related people, most of whom are like, I don't know. I don't want to characterize them as permabulls, but their incessant optimism is grating to me. Who just what they continue to say is that housing is going to keep going up. There's just structural undersupply. Undersupply won't get solved, and now God King Powell has blessed us with mortgage rates back into the 6 handle and perhaps a 5 handle soon, and that the party is back, and we go into the moon baby. A lot of sentiment like that around housing space. I still don't understand it because the average affordability is still just beyond the reach of a normal person. I just can't comprehend how people have that view that prices will continue to rise. But I'm on a buyer's strike. I could afford to buy a house, but I refuse to because it's cheaper to rent. Why would I buy a house? It makes no sense.
Yeah, I mean, well, obviously we do need more supply, so we do need to build more. And I do understand the fundamentals behind the large home builders. I just don't agree with the current pricing, and it seems like we're switching from the way we used to price home builders to they're typically not valued as a PE ratio, and it seems like I don't know. People are trying to forecast future earnings when they're that's not how they've been valued in the past. But some things the realtor lawsuit actually does allow the home builders, the mega home builders, a lot more strength with dealing with them. Toll Brother says 1.5% of their revenue goes to realtors, and if they can claw any of that back, they will in the future. I mean, not claw it back from the past, but not pay it, as high as commissions in the future, they will. And that's kind of huge. But I think the home builder space is a little overheated right now. But at the same time, knowing that we do need, the cure for high prices is more homes, not less.
Yeah, and I mean, you would know far better than me because it's not a space I follow closely. But just from my understanding, a lot of the home builders' balance sheets are also materially better in terms of the amount of leverage they're carrying. So their, I guess, susceptibility to, if we get on the demand side a big deterioration, they can absorb that better than perhaps in the past when maybe they would have had to be more aggressive on concessions and price cuts and the like. I mean, and I know that the build, as a mix of housing sales, new versus existing, is what, like an eighth of that of existing. So it's still relatively minimal.
Well, yeah. So typically new home sales should be like 9% or some in that 10% range, and I think it ramped all the way up to 30% because people weren't listing their homes because they were locked into they weren't. So the only thing to buy, not the only thing, but a larger percent of the for sale inventory was new houses. So and these large home builders could offer rate buy downs, and that so the bull case on home builders, and I think this has all been priced in. The bull case on large public home, like pre 2008, the large public home builders were about less than 30% of the total new home market. Most of the homes in the nation were built by smaller mom and pop companies. After 2008, the mega home builders really became mega. Like Lennar is a completely different company now than they were pre 2008. And they are now they either cross 50% or they're going to cross it soon, and they just have structural advantages over medium small home builders that we can't compete with. I mean, they termed out their debt. They can offer rate buy downs. They own land. They have options on land. Land is a real big issue moving forward. So I get the bull case. I just think either all the analysts know it, or it's all priced in. Like the best case scenario for the large home builders looks to me like it's all priced in, and it's like, well, I mean, but they're also pricing in that rates are coming down. And that's another. You mentioned the 10-year earlier. Like, what is the 10-year priced off? Is it priced off the forward rate path of the Fed, or I'm confused because it seems like everybody has a different. But in 2001, the 10-year was what, at below 3%, and now it's at it was 5% a month and a half ago. I don't know what's changing.
Well, the other issue is the spread between the. There was a huge expansion in the spread between the 10-year and
the more 30-year.
The mortgage rates themselves were, and I think it's still very wide. It's come in somewhat. There could be more of that. So,
contraction.
Yeah, like I don't know. It still is just a math problem. I cannot comprehend when I look at what prices are, how much people earn, and how much their housing payments are going to be. The math just doesn't add up to me. I don't understand it. I don't understand why people are in such a rush to buy homes instead of just rent. Some, it seems, and that's, I guess, somewhat cultural and peer pressure and the like, depending. But
well, there's people with built up equity. So when they sell, they're not coming with 20%. They're coming with much more equity.
No, I mean first-time home buyers.
Oh yeah, they've been. Well, if you look at they have exited the market for the past year.
Well, they were forced out of the market.
Well, yeah, I get that, but yeah, they have not. The boomers have been, for the past year, have been, essentially.
That's the part you're spot on, and I've seen a lot of people refer to this. That's why they're so mega hyper perma bullish, that there's just so much equity. There's so many people who don't have mortgages that have so much wealth that if they need to or want to tap into that, we're going to be A-okay and sail right through it. But like, to me, it's just this weird spread between the boomer haves and the millennial and younger have-nots. And what happens over the coming years as they die, to put it, I guess, bluntly, and now they've got to, transition those assets. I mean, there's going to be a huge wealth transfer to younger people. It's going to be wonderful for the people who receive some wealth and the transfers, but like the people that are actually trying to create families today, if they are a first-time home buyer, they are priced out of the market still, and if the perma bulls have their way, those people will never be able to get back in. I mean, the math cannot square itself to me. I don't understand it.
Yeah, so I think that prices in nominally stay kind of at this level or kind of drift lower, but in real terms they're going to be coming down far, because people are, across the spectrum, people are getting rate, unless these strikes and all this was just a one-time thing and wage pressure is going to stop, which I don't see it stopping unless the economy slows materially, which, if rate cuts are on its way. And
the volume of labor actions that we've seen this year don't seem to imply that pressure on wages is imminently dissipating. If anything, it goes back to my just not comprehending why the Fed is so comfortable to juice this punch bowl when wage pressure seems like it's still there.
Yeah, because the boomers they're not only just going to be leaving. They're going to be they're leaving the labor market. They're the second largest group. They're leaving. They have one of my things that I kind of think about is they've saved up money for 40 years and they weren't in the position in 2008 to be like to retire and spend, so they all freaked out. Well, now if the recession that everybody's been wishing for, Jamie Dimon and they'll go out and take their their fifth vacation that year and spend because they're 70 years old and they have all this wealth. So I just see the continued pressure on labor as our working age population becomes older and less, and the amount of money that's being spent by the government and the baby boomers is great until that and so that brings up our wages. Hopefully interest rates come down and then we kind of squeeze this affordability. There's three prongs of housing affordability: price, rates, and wages. So wages goes up, prices go down a little bit, and along with rates.
So I'm just using one example, my own, but I'm looking at houses in my neighborhood. If price didn't decline, I would need rate to drop to 4% on the 30-year fixed for the math to be around parity for buying versus renting. Granted, that doesn't consider the principal portion of it, yada yada, but that's not gonna happen. I don't think we go back to 4% interest rates. On the other hand, then you need prices to come in. Let's call it at a 6% rate. You'd need price to decline by between 10 and 15% to get to that same kind of payment. And that's what it feels like would be good and healthy. But because people who may otherwise want to sell still find themselves with the golden handcuffs, if you will, of that 2-handle, 3-handle fixed rate mortgage, like you almost need, and it's tough because you all the policy does is encourage more and more and more demand, and what you want policy to do is encourage supply. And I don't know that this does it, but you almost need some sort of a scheme wherein people that have these low fixed rate mortgages have a mechanism by which they can move out, they can sell or whatever, and not have this issue where they're going to go from a 3% to a 7% or 6.5% or 6%, and it just has the market frozen still. So I don't know. I guess let's look over the coming weeks and months as we get into the spring selling season. If rates keep moving in this direction, like, do we get back to a 5-handle on 30-year fixed, and what does that do? I see prognosticators saying that we get something like that, and you see a big uptick in housing demand again. And I don't know, just going through again my example here, I can't do it. Prices have to come down for it to make sense.
Yeah. Well, I would say you're an outlier in the way you think. That just, and I mean as in the best way possible. But you're thinking. I
appreciate what you're saying.
There's people that, I mean, they think they're doing the best, and maybe they are. I don't, but they don't.
The
they don't look at everything.
The question isn't the break evens and all that. It's how much house can I afford? And it's what's the yard? Wage, here's the interest rate, and thus I can afford this payment, which equates to X. Yeah.
What's the yard?
Same as when they go buy a car.
What's a little more debt?
but the car dealership guys don't like me.
Yeah. So yeah, and then the 10, like what I you mentioned Bill Gross. It's like I don't understand. We were heading, it was, and I knew a lot of that was narrative, like the supply. All of a sudden we're at 5% on the 10-year yields. Then now it's like, oh, now we're going to go to 3.5. I guess I'm almost more confused by the bond market than the stock market. Did you listen to any of the issuance? Like, where they're talking about like 12, how much? issuance where they talk like post debt ceiling?
I think it was 1.6 trillion in the next 6 months.
Yeah, something crazy.
But they also have 8 trillion of debt they got to roll over too, right? I can't remember when that happens or what months that debt rolls over in, but yeah, they got a lot of new issuance on the horizon here.
Yeah, I don't know. I still feel like housing is broadly bubbly, and the notion that it can just remain and re-expand, to a further, I guess, bubble. I don't know, but it goes back to what I was saying about, is this just a continuation of policy mistakes like were made in '98, and we're going to see a stupid melt up bubble re-expansion and then implosion? And I hope that doesn't happen for the sake of just how that impacts people's lives negatively on the downside, but who knows?
So what do you think the Fed should be doing?
I I would go back to Wednesday, and it wouldn't have been a celebration. It would have been, we've made a lot of progress. The hardest part is still ahead of us. Instead of declaring victory, essentially, I don't think that they have not assured me that the risk of inflation becoming unmoored from stable prices, their purported goal, is gone. I think that risk is still there. I think that their actions have reignited that risk. And while I get that now they're trying to switch to the full employment side of the mandate, how can you in good conscience try to articulate that now being more important when you told us quite explicitly that you cannot have full employment without stable prices? So I think they blinked, they pussied out, whatever you want to call it. And if kind of thinking about that wage data, if we keep seeing just too much strength and too much growth in wages, then they are going to have to in January come back and like reassess and potentially March not cut, because it's just we would, it is, to me, it's better for them to err on the side of remaining too tight for too long than to do what they now appear to be doing, which is somewhat preemptively cutting and loosening policy, sure, from restrictive levels, but that reignites that risk of prices becoming untethered again. And then they're back at square one, which means then they have to raise, hike and tighten policy to try and get prices back down to stability. So I think that they made a mistake, and we'll see. Perhaps they will prove to be brilliant with the benefit of hindsight, but I think this was an unforced blunder.
Yeah, so I agree, and what I found most interesting is if you went back to the last meeting, he talked about, Powell specifically mentioned the financial tightening that had taken place in the market.
And then you
10-year going up.
Inverse of that, but not a word spoken around about it.
Yeah, and I think that's what the market reacted to after Wednesday, because I was like, going into the meeting, I was like, the market front ran the Fed based on all the Fed speak of the others, out in front of Powell, and he could have like said, hey, they're still paying. What is the quote? The job's not. He kept on using what's his name? Till the job's done or whatever.
Yeah.
you know, so yeah, I agree that, because some people are trying to say it wasn't a pivot, and I was like, well, he didn't talk about, basically that
It was a pretty stunning pivot.
we undid a whole, a month and a half of tightening, and then past that, it's even gone much farther. So, we'll see. I mean, you're going to see it. You watch the continuous job claims, but the places that you'll see it the most is in the mortgage application data. Every Wednesday that comes out, and if we start to see like a severe upward trend, then in February we're going to see some big sales prints, and so, and if maybe they know that won't happen. If we go to 6% into the 5%, so we're going to see a huge, not a huge, but bigger than last year's rally in housing.
Yeah. Well, melt up gang, blow off top gang could certainly have their way in 24. Obviously, not one of us here has a magic crystal ball, or we wouldn't be here. But I mean, that you're right. That is what to look for. If you see mortgage rates really amping up activity and volumes for whether it's refi or just new application activity, like, I don't think the Fed wants to see that. I don't think that's in line with their mission.
Well, they should, at this point they shouldn't, because that could reignite inflation. But if you do see it, wouldn't energy be a great place a safe play? I mean, I think it's a safe play anyway, but
I mean, if you think inflation will then rear its head, then real assets, energy producers, I guess commodities should do well. And I think material companies, a lot of energy companies are still among some of the cheapest in the market. Like, at least at the sector level, energy is far cheaper than the market writ large. I mean, energy is actually still down year to date. Nasdaq's up 52%. XLE is down 1%. Energy is cheap. Energy is cheap on most like fundamental bases. Like, if you just look at cash flow, and granted, are those cash flows elevated because of, again, if you look at trailing earnings versus forward earnings, things can always look different. Especially if you look at like some of the refiners. If you look at their trailing earnings that still have a quarter of 22 boom time in it, like they're trading like 1.x on trailing PE. You can't eat trailing earnings. So, but yeah, like I shared this, and I know I shared it with you in the chat. Like, I still think that a lot of the producers and refiners are mispriced because they are almost priced like it's going to be a recession. And if every other part of the market is not pricing that, either they're priced wrong or everything else is priced wrong. Is kind of what it comes down to.
Yeah, how can you have all, what's the Nasdaq forward PE, and they're pricing in all the, what's the percentage earnings they're pricing? You can't have that and then not have a ton more energy consumption,
right,
and inflation, and we have China, what the world energy economy basically at a lull because of China. China growth has been slower coming out. European, it's like we're at the point where if the U.S. central bank starts cutting, then Europe is going to start cutting, and Germany might get off the mat in the next 6 months. I see a lot safer and better opportunities in energy than a lot of the other parts of the market.
Yep. Second that. All right. Well, we're 10 minutes to the top of the hour, so probably can start, I guess, wrapping up. Thank you very much, cohort Rocket Randall Sick, for chiming in on the panel today. As we mentioned at the onset, this is the last Wook in Review of the year. We started doing these in late 21, and we've done them all year. No, sorry, not late 21, late 22. Excuse me. So we've been doing them for over a year. If anybody has any feedback, let us know. Still don't know exactly what we're going to be doing next year, but we appreciate your interest for sure and the engagement. Hopefully people enjoyed the discussion this afternoon. And yeah, I hope I can come back next year and have a better year than I did this year. So, Joe, I don't know if you want to add anything.
Yeah, guess I'll throw out some parting thoughts for the year. We'll still send out a newsletter next week, but no more spaces this year. We're gonna wrap it up. Little vacation for the holidays for the team, it sounds like. And with that, thank you everyone for tuning into all the spaces this year. I mean, I'd like to know the numbers. Maybe I have to run them when I do my newsletter for next week. But just how many total viewers there were through the year. I mean, sometimes we'll have a space where we get 1,000 people. Sometimes we have a space where we get 100 people. But I'm curious, our total viewership for the year, it's probably a pretty high number. So really thankful for everyone that tunes into these spaces. The conversations are great. I hope we provide value to traders. And if you're not, the most experienced trader or the most experienced trader, you still take something away. That's the goal. So thanks everyone for tuning in this year. We'll be back with something next year. We're gonna maybe change up our programming a bit, but hopefully still engaging in these spaces. So thank you everyone.
All right. Thanks again, everybody. Stay safe over the holidays and Happy New Year. Merry Christmas. Insert nicety here. Farewell for now.